Welcome to Alliant Credit Union's presentation on demystifying student loans. My name is Melinda Cardona, and I'm a Strategic Partnership Manager here at Alliant. If you have questions throughout this webinar, please refer to the Q&A section on the right-hand side of your screen, and I will be able to answer your questions live. This webinar has been pre-recorded, but our Q&A session is live. Alternatively, my contact information will be made available at the end of this webinar, and you're always welcome to reach me personally via email or direct line. And whether you're joining us today because you have student loans currently, or you're thinking of taking a student loan, we welcome you to this forum and look forward to sharing this information with you. In today's brief presentation, we will cover the following topics surrounding student loans: the current state of student loans and how it affects most Americans, government loan options and alternative funding, FinTechs, what they are and why they've become such a heavyweight in the marketplace, and loan types, traditional versus consolidation loans, what the differences are and which is right for you. And lastly, Alliant resources, who to call and when.
You are not alone. 40 million Americans have student loan debt. 1.4 trillion is the amount of student loan debt in the United States, with an average balance of $37,000 owed per student loan. Next up, we'll discuss government loans.
There are many types of government loans. On the next slide, we will discuss the types of loans and define them. There are 4 types of government loan options. Direct subsidized loans are on a needs-based eligibility. Interest does not accrue while the student is in school, and the loan limits are on a sliding scale from $3,500 for freshmen to $5,500 for seniors. Interest rates are currently 4.29% with about a 1% origination fee. Direct unsubsidized loans are available to all students regardless of need. Interest begins accruing when the loan is dispersed, and the loan limits are also on a sliding scale from $5,500 for freshmen on up to $7,500 for seniors, with the same origination fee of about 1%. Direct Plus loans, well, these are parental loans, and the interest rate is currently at 6.84%. And a direct consolidation loan combines all eligible federal student loans into a single loan, and the interest rate is a weighted average rate of the existing student loan. Student loan gossip. We are in an age of information overload, with search engines at our fingertips and an overwhelming amount of information available online. How can we begin to sort through it all? Let's start with some student loan gossip that we hear each week upon visiting our select employer group. One myth I've heard is that I hear student loans that are private have a higher interest rate. That statement simply isn't true. While government loans have a set interest rate, depending on the type of loan selected, private loans can actually have a rate based upon credit. These rates can be as low as 1.9% on up to, I've seen as high as 25.5% APR. Generally speaking, for-profit financial institutions will always have a higher interest rate than a non- or not-for-profit institution. And as always, having good credit always comes in handy. The higher your score, the lower you can expect to pay in interest. Another myth I hear frequently is that only government loans offer forbearance. While I can't speak to all lenders and practices, I can tell you that Alliant's a private lender, and we offer up to 2, sometimes even 5 years in deferment on some of our student loans. I'd be interested to hear what kind of gossip you've heard in your community. I'd be interested in demystifying some of the things that you've heard, so please take the time to type in your question into the Q&A box on the right side and send me a note. I'd be happy to answer your question and your curiosities on student loans. We've talked about federal or government loans, and now we'll discuss private loans and the many differences between the two. Let's discuss the differences between private and federal loans. Private loans offer rates that often depend on credit, and having a cosigner can often lower the rate offered, whereas a federal loan does not require a cosigner, and the rate is standardized regardless of credit. Private loans often offer additional benefits, such as a lower rate when automatic payments are applied to the loan, and access to other financial products are made available, like savings, checking, or other loans. Depending on the unique situation of the borrower, federal loans may offer additional aid and generally do not require a credit pull. Federal loans also offer flexible repayment plans, like the income-based or sliding scale repayment plan. Oftentimes, federal loans will sometimes offer forgiveness for certain public sector employees, such as educators. And lastly, often, private loans will have the same rates available for undergrad and graduate programs, with little to no origination fees. Let's discuss FinTechs. What are FinTechs? FinTechs are viewed as an alternative, non-traditional lender. But the reality is they're for-profit and often work with the big banks, simply originating the loans and selling them to investors. Originally, FinTechs were rooted in peer-to-peer lending models, but are no longer peer-to-peer lenders. They've evolved to become more dependent upon institutional investment capital and primarily focus on 1 to 2 loan offerings and receive little oversight by regulators, for now. FinTech attributes include maintaining an element of social cause, distinguishing themselves from big banks, even as they may continue to work with them. And they're predominantly digital, with aggressive marketing campaigns, and are viewed in the marketplace as disruptors. Lastly, FinTechs focus on lending, offering no deposit, checking, or investment products. We often hear the term traditional or consolidation loans. Next up, we'll discuss the differences between the two terms and help you determine which might be best for you. Traditional loan repayment options. An in-school traditional loan offers 3 repayment options. Deferred, meaning no payments while in school, plus 6 months post-graduation. Immediate repayment, where payments are immediately made following the funding of the loan. And interest only, meaning that while in school, principal repayments begin 6 months post-graduation, and the interest is required to be paid immediately following the funding of the loan. Consolidation loans. It's important to note that the government allows government loans to be consolidated, not refinanced. There's no rate reduction. Consolidation is when you take multiple loans, usually with different lenders, and you rewrite them as a single loan. Refinance takes your loan to a new lender that offers more favorable terms than your current lender. I cannot speak to other lenders, but as an employee of Alliant, I can tell you a little about our refinance loans. They require a $10,000 minimum, $100,000 maximum, and you can consolidate both private and government student loans into one loan. Any cosigner can be released in as few as 36 months. The repayment terms are up to 25 years, with 15 and 20-year terms available based on the amount that you borrow, and additional forbearance options of 6 months are available. Rates are 3.75% APR with the same rate for all term lengths, and they adjust quarterly. School eligibility is 4-year undergrad, master's, or professional program with a public, private, or not-for-profit school. Proprietary schools are not eligible, and they must have a published cohort default rate. The borrower and cosigner eligibility is that they must be employed for 2 years with their current employer and a $40,000 a year income. Citizens or eligible non-citizens, and for permanent residents, we need proof of permanent residency, and it is required that you have a Social Security number. Just a gentle reminder, if you have questions about cosigners, policies around cosigners, and maybe what the process might look like for you to refinance, or just any other burning question, please take the time to type your question into the Q&A bar, and we'll be answering your questions live. Moving along, an Alliant traditional loan features a minimum loan of $3,000 with $15,000 per year max for undergrad, $30,000 max per year for graduate loans, and $60,000 max aggregate total. The repayment plan is 12 years, and the cosigner can be released from the loan in as little as 36 months. What's most amazing is that Alliant offers up to 5 years of deferred payments. And as a reminder, these types of student loans cover tuition, books, materials, and room and board. All right, we've reached the question portion of the presentation. And if you have any questions, please type them into the Q&A portion on the right-hand side of your screen, and we will answer them live. I look forward to speaking with you soon. We've reached the conclusion of our presentation on student loans. We thank you for your time today. Tune in next month for our Webinar Wednesday to learn more financial tips. Webinar Wednesdays are on the last Wednesday of each month. And if you're not already a member of Alliant Credit Union, we invite you to join online at alliantcreditunion.org. Thank you again for joining us today, and we look forward to serving you in the future.